Welcome to Money on Tap, your personal finance headquarters. Money on Tap is where we bring out the professionals, experience, and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do here on this podcast or radio show, however you're listening to us today. We're glad you're here. We're going to take a look at all sides of the issues and bring a fully independent planning perspective to the table. My name is Seth Cressman, and I'm joined here once again with John Ryder and Ben Brayshaw. Good morning, guys.
Good morning, Seth. Seth, John Ryder's eyeing my coffee. I think he's looking to steal it.
It's looking really good, Ben. It's served in a kind of a crazy look. Is that a Starbucks mug there that I see from one of your travels there in New York City?
Nope, this is deep down in Boston.
Oh, deep down in
it's a Boston
Beantown.
mug.
Yeah, it looks good. What are you drinking there?
I wouldn't be drinking out of a New York cup.
I would hope not. I would hope not.
I'm not a Yankees fan. I'm a Sox fan through and through.
You're a Pats fan, but we're not going to talk about that right now for sure.
Not
so
Pats.
Now, my coffee does not look nearly as pretty. Mine's coming out of a travel tumbler here because I'm afraid that sometimes it's just a wreck. In the mornings trying to get everything put together. And I don't want, I just set it down there. I don't want to make a mess here today. I want to make it clean.
Mine's exceptionally frothy this morning.
Yeah, I was wondering what was going on with that.
Yeah, I tell you, this coffee maker's pretty good.
Good.
Yeah.
Well, hey, man, I'm excited about our show today. We have a good show where we're talking about volatility in the markets.
Hopefully more than the froth on Ben's coffee.
Oh, yeah. Well, yeah. So
it's probably the best news we've got.
Yeah, market's a nightmare, but the good thing about it is nightmares do end.
And being prepared for the nightmare can be better too. So we're going to talk some about that too, just because there's a lot of people out there. Like, guys, if we turn on the TV right now, and Ben, sometimes you have CNBC scrolling in your office there. Sometimes we have something else on. But if you pick up your phone, there's so much negative news. However, if you're well prepared for these negative times, you can be doing a lot better than if you weren't. So we're going to talk with everyone today about what to do when the market drops, but we're also going to spend some time talking about what not to do. So actually the title of our show is What to Do and Not Do When the Market Drops, because we have been seeing some crazy volatility. And also we have been seeing some signs, not necessarily with our individual clients, but we've been seeing some things where people say, the markets are down, I'm out of here. And that can be a very dangerous thing to do. So we're going to really spend some time talking about what to do when the market drops, but also things to avoid, what not to do. But before we do that, it's going to be time for us to be talking about money in the news.
Now, this is one of the better articles I think we've had, John, because if you just lost all of your money in the stock market and you can't afford KFC at home for dinner, you can buy a fire starting log that smells like KFC.
Okay, so where have I been all my life where I have not heard about this? I think for the last couple of years they've been doing this, but so KFC makes this actual log that you can buy. You can put it right in your fireplace, Seth. That smell. Okay, so by the way, this is
smells like a fast food.
I know. So this is a little bit more expensive than your average log that you might throw in there. So obviously we know the cost of wood is expensive, but if you buy this one fire log, it says here, KFC fire log, 11 herbs and spices. It smells like fried chicken. Okay, so guys, I don't know if you guys ever spent any time in any fast food establishment working. I never did, except for one 3-month stint where my dad said, I don't want you working for my company. I want you working for someone else to realize what it's like to work for someone else. So we had this lady in our church who actually happened to be a hiring manager at KFC, and I talked to her, and I worked for 3 months of miserable months of my life at KFC, realizing that, yes, college does need to be a part of my future.
That is I never knew that story. Okay,
Never.
So working the drive-thru.
So my dad owned a business too, and he must have got tired of me working for him too. He said the same thing.
Yeah.
And McDonald's had opened up down the road. I worked there for about 3 months,
Did you
and
really?
I was like, I'm out of here.
Yes, it always makes you realize, well, there is life after this, and I need to do something different. And and nothing against people there's some people that have worked in the fast food industry for a long time. In fact, my uncle owns a few of these type places. But the fact is, it's it leaves much to be desired. But I can't imagine wanting to actually have that smell in your house, having worked at a KFC for 3 months. It was always something that you couldn't get out of your clothes after you left.
That's exactly right. Anytime that you start doing some, I cook a lot. And you guys know that. That's like one of the things I really love to do, and it shows. My extra 20 pounds this year that we're gonna get to the New Year's episode.
Seth,
and our
you're looking
resolutions.
terrific. You're looking terrific.
It gets better. This article gets better, boys. I mean, look at this. In 2016, they gave away 3,000 bottles of Colonel Sanders Extra Crispy sunscreen.
Right.
So if you couldn't get it out of your clothes, why don't you bury it in your skin?
Here's what I don't get about that. And I understand it. It says in 2016, the chicken chain gave away 3,000 bottles of Colonel Sanders extra crispy sunscreen. What does that mean, extra crispy, for when you're putting on sunscreen? I don't think that should be part of when you have sunscreen. Isn't that to avoid the extra crispy?
I would so be looking for I would really want to be downwind so I could just be inhaling and gathering that extra
being on the
smell
beach and being
coming off of you.
Oh, KFC. Who's got it?
Who's got KFC?
Well, how about being at your home at Christmas and putting a fire log in that smells like KFC?
Well, I'm wondering if it takes like a month to get the smell out of the furniture with the fire log as well.
Yeah. But here's what I don't understand. It says it gave away 3,000 bottles, but it said the lotion quickly sold out. So are they selling it or are they giving it away? I don't know. I can't imagine paying for that. But anyway, I guess these restaurants are looking at ways to make money and ways to profit in different ways, and maybe it's not always off of selling actual food.
It feels a little bit like the shark jumping the shark.
Yeah, maybe so.
We can't quite figure out how to make money off of our traditional model, so we're going to go ahead and start selling fire logs that smell like chicken.
I mean, I told my wife this, and she goes, "Oh, that sounds awful."
Let's expand the chain to fire logs and sunscreen.
Well, it goes on sale. If you guys want, it goes on sale. I mean, I don't know. I think you can even buy. Can you buy this at a KFC?
I want somebody to make like a gag gift. Like this is a gag gift, but I want somebody to make the gag gift that like smells like spoiled Colonel Sanders chicken, or like those vomit jelly beans and stuff like that.
Oh yeah, those things are disgusting. The ones. Oh my word! Someone gave me one of those.
It's
things
amazing what people think of. Yeah. Yeah.
What person at the top says, you know what we got to do? We got to make sunscreen that smells like KFC. Why are we doing that? Who in marketing didn't figure this one out yet?
Oh my gosh. Oh.
Guys,
yes,
we've been talking. We spent some time.
Should we get sunscreen that smells like money?
Well, we could.
I mean,
maybe
that's
that could be a side.
I've never asked. Maybe that's a side business we
can talk to compliance and see if we can sell sunscreen that smells like money. Yeah, we could do that. I'm sure.
Or a fire log that smells like your money burning in the market right now.
Yes. Well, people feel that. That's for sure. So, but hey, guys, our next article is we've talked a little bit about this before, but one of the things that we often talk about, and one of the things that here at Money on Tap, all three of us really have an agreement on. It seems so much of the time, that government gets so involved in things and the regulation, the taxes, all of it. We don't like any of that stuff. We don't like the regulation. We don't like the taxes, all that. But it seems like we've had this conversation before about California. The title of today's article, our second article from the Dallas Business Journal, is entitled this: 1,800 companies left California in a year, with most bound for Texas. So we all know that California is kind of known for every single environmental reason for companies to leave. And one of the things we talked about, Seth, in the last time, I don't know if you remember, we were talking about the U-Haul index.
But it's not just that; it's taxes too.
It's all of it. It's all wrapped into one. But everyone is saying, or most of these California businesses are saying, the climate that we are experiencing here in California is so bad that we have got to figure out where to go and where is it more friendly to go.
Well, and think about the business costs too, John. I mean, like if you have to pay 12% income tax plus whatever, federal income tax you're at, plus the cost of living in California, just to staff the same company in California versus Texas is night and day. night and day costs.
So there's a guy, Seth, that actually ran this study, and this was from 2016. And I know it's still going on now, but he showed that 1,800 businesses had left, and he said that this has been happening since 2008. They've had about 13,000 companies leave the state during that 9-year period, but of the 1,800 people leaving the state in 2016, about 300 of them actually landed in Texas, which is a very, very business-friendly state. They're attracting business like crazy. I have a client that lives right in Frisco, Texas, and she said that the value of her home has almost tripled over the last several years because everyone is knocking down the doors to get in there.
Yeah.
Wow. Yeah, and real estate is relatively inexpensive in comparison to a lot of the...
Absolutely.
Yeah. So there's my brother-in-law actually is from Texas, and he's an entrepreneur as well, and he's been doing everything he can to get back to Texas. And he was describing to me some of the differences in, like, establishing a company and getting, everything up and running and what it takes in Texas versus Oregon. And there's a difference there. So I can only imagine how much easier it is for, these larger companies to, carve out a footprint in Texas versus even, Oregon or, some of the other states that show up as being, positive, beneficial climates for them and where they're moving. Like Texas is number 1, Nevada is number 2, Arizona, Colorado, Oregon, Washington, North Carolina. I think it's interesting that after kind of like your regional moves to the, the Nevada and Oregon and Washington, it jumps over to North Carolina, Florida, Georgia, Virginia. And so, I mean, those must be substantially preferable environments for them to make that large of a move.
And guys, it's not small mom and pop companies necessarily leaving. Like I have a cousin of mine who did business in California, a smaller company. It's a rug manufacturing business, smaller company, but it's a large company. So in the past 3 years, California companies like Toyota, Motor North America, Kubota Tractor, Charles Schwab, all those big names, Jamba Juice, all of those have moved and relocated. And the top reason, the guy that did this study says, the top reason to leave California is no longer just high taxes, although it still ranks highly. He said the legal climate has become so difficult that companies should consider locating in jurisdictions where they'll be treated fairly. Actually, the guy that did this study is actually putting out advice to California companies. Hey, listen, if you want to save yourself some aggravation, you want to save yourselves a lot of money, maybe it's time to skip out of California and go to one of these other places.
Yeah, well, there's a huge population. I mean, if you're looking for employees, I mean, they're there. So it's hard to kind of step outside of that sometimes of where the people are available that have the skill sets that you need. But to take a look at the labor costs, the punitive regulations, the worrisome housing affordability for employees. I mean, that's the other side of it too. Is like if you have people in that location, how do they live? And they can live so much better in Texas than they can in California.
Are we seeing so many reasons, Ben, not to be in California? I don't know what it is. I know you're not a huge fan. You've visited. You're in and out on business sometimes in California. You have many clients in California, but it seems like lately, I don't know what it is. Is it the fires? Is it articles like this? It's make me think, California's not so great.
Well, I think if you're really close to the coast, it's beautiful. I mean, there's parts of it that are really amazing, but not my cup of tea. I mean, I've been there a number of times. It's just not. I get why people like it, just not my thing. So I'm an East Coast boy. You always will be.
Yep. I'm with you. Hey, what's interesting too? Not only are companies leaving California and going to different states such as California, Washington, Oregon, all that, they're actually relocating to other places too, other countries. So if you take a look at it, there's kind of like a top 10 place of where California businesses are going, which is kind of sad actually, because you don't want these companies going out of the country. But top place jobs are going to, well, this makes sense, Mexico.
But this is why Trump lowered the corporate tax rate.
Exactly.
To keep companies here. I mean, he's figured, if we're going to keep, if we're going to keep jobs in America, we have to make it affordable for companies to not go.
Which he gets. Yeah.
Raise tariffs, lower taxes. That keeps companies here.
Absolutely.
Amen, brother. You're listening to Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. You can also find us at Facebook at 3D Investing. And you know what? If you're looking for us out there and you're scouring the web and you're needing your money on tap, just check out any of the podcast venues out there. We're there as well. And we appreciate you listening today. We're going to take a quick break. We'll be right back.
Hello, my name is John Ryder, a partner with Brayshaw Financial Group and one of the co-hosts of Money on Tap. 10,000 Americans are turning 65 every day, and planning a successful retirement today is more challenging than ever, with a roller coaster stock market, political and economic uncertainty, and so many unknowns when it comes to the escalating costs of healthcare. Let us show you how we utilize the 3D method of investing, utilizing insurance, brokerage, and fee-based planning. Using our experience, let us help you plan for a successful retirement. Now is the right time to start getting help. Give us a call at Brayshaw Financial Group at 855-226-8551. Headquartered in Bedford, New Hampshire, we have offices across the country. We would love the opportunity to meet with you. There's absolutely no cost or obligation to meet with us, and we welcome you to our offices. Call 855-226-8551 today.
Now back to Money on Tap with Ben Brayshaw, John Ryder, and Seth Cressman.
Welcome back. You're listening to Money on Tap, your personal finance headquarters. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And if you're out there in the podcast venues listening to us, some of the past episodes that we've had, we appreciate you liking us or, any of the comments that you have out there. All that stuff really is appreciated. So thanks again for subscribing to the podcast, liking the podcast, commenting on it. It's all appreciated. And also you can find us at Facebook. If you're on Facebook, we're at 3D Investing. So we are talking a little bit about some things in the market. It's an exciting time because the markets have been roiling lately, and a couple of the stats that I was just going to outline here is like today, actually, if you take a look at the S&P, it is down 0.91, and or the Dow Jones, we've gone to a negative 0.28. Some of the other indices have moved into what's considered bear market territory. Over half of the S&P is traded into a bear market territory. That might be a little scary for some people that's where they position their portfolios and that's what they're relying on to try to get them into a retirement zone. And we're going to talk about that. We're going to talk about we're going to try to bring the fullest of independent planning and Brayshaw Financial Group to the table here and be talking about some of the hard topics and maybe some of the things you just haven't heard in the news. Yeah,
I just saw an article, guys, that I share with the guys that was entitled "Market Volatility: A Return to the Old Normal." Now, we have certainly been experiencing
that title just kind of warms my heart.
Yeah, I know. It's just wonderful. Isn't it great? Back to the old volatility. But the truth is this: we have seen a lot of volatility in 2018. There's no doubt about it. We've seen a lot of ups and downs. We've seen kind of a lot of whipsawing where the markets go up crazy, then drop down quickly. Just a lot of different things. And maybe part of that is attributable to our commander-in-chief. I don't know. Sometimes the tweets go out, and maybe some of that is attributable to that. I don't know. But the fact is, and this article really brings back to perspective, that 2017, quite honestly, was a year where we just kind of had a steady growth across the board. It wasn't crazy. We didn't see a lot of multiple points exchanging up and down. But if we remember the years before that, 2014, 2015, 16, 17, through 16, just a lot of volatility. And it just seemed like we got a break last year, and this year we were kind of back at it. That's kind of my thoughts, man. As I look at the markets here and just seeing, I don't know if it's been all that crazy, but it just feels crazy because of.
Well, look at the last, I look at the last 12 months of the market, and we're basically flat.
Yeah.
All the indices are trying to close positive. Apple's is trying to close positive for the, if they close negative for the year, that would be the first time in, I can't remember how many years it was, but it's like 15 or 20 years or something crazy like that. So, those are. Go ahead.
I was going to say the S&P and the Barclays, if they were to close, if we were at end of year, they would both be closing in a negative position from last year, and that hasn't happened since 1977.
Yeah, those are. We're kind of in a weird time, and I think people have become. a little numb of 2008 because we've recovered a lot of it. Even the people who got in after the recovery are still kind of like getting back to square one, and people are starting to feel like, okay, maybe the markets are trusting again. And I've noticed, John, in the last year or so that we've had a lot of conversations with people about how to invest and the different types of ways of investing and so forth. And I've found that people are a little bit more, I can do it on my own. I can take care of it. We can be passive and so forth. And we have, and we do passive investing all the time for people. But, but that's usually where like, you should have some of your money in tactical. You need something looking at a tactical effort in some capacity.
Absolutely. So basically what we do, we are going to see drawdowns in these markets. They're scary. But one of the things that we always do when we're working with clients' money is we always build portfolios knowing that those times are going to come. So we know that there's going to be volatility, and there's a reason why we choose the securities and the underlying portfolios that we do. So let's talk, guys, I thought today we'd spend some time talking about some of the things that we're seeing. So Seth, when you turn on the radio, when you turn on the TV, are you seeing lines like the Dow tumbles nearly 600 points, or here was why the market was up today, extending a rebound?
Oh, I love how they make assumptions of why it's up or down. Yeah. Like they have really no idea most of the time. I love that. I'm like, oh yeah, rumor of Trump talks on China sending the entire world. No, there's a ton of people who are passively trading their investments at, Fidelity or Charles Schwab or someplace, and they're saying, you know what, I just want out of this market because this looks scary.
Well, we're seeing sound bites like this. We're seeing sound bites that say things like this: bumpy stock market ride, investors are holding their breath, or the cycle of volatility continues, I think it's really the media hype that causes a lot of the financial anxiety here. And it's just one of the things that I think will put the most trepidation in anyone's heart is when they actually open that quarterly statement that they got from their 401k and they see, okay, so I had $100,000 there last quarter, and here I am at $86,000, and that makes me nervous. So let's do this. Let's spend some time talking about the things to do when we see the markets drop. Because when you're listening to this, I don't care if this is 2018, 2019, 2020, you are going to have times where you open that statement up and you see the markets dropping big time. So the question is, what do I do? Do I get on the phone and call my financial advisor? What do I do? So let's talk about that a little bit. What are those things, Ben, when you go home and you get your statement, because you get statements just like the rest of all of us, when you see that statement and you see that the markets are down, you see your portfolio down by 10%, what's the first thing that you want to do when it comes to that kind of thing? Do you sell something? Let's talk.
I think that's really going to depend on exactly what you're expecting. I mean, this is the thing, right? People make reactions to investments based on what they hear on the outside, not articulating in their head, why did I buy this? What am I expecting out of it? And am I on track to accomplish that? Right. Yeah. So when you look at a particular investment, like, if you own Apple stock, it's trading at $168 a share. It was down to $164. We talked about how it's potentially could close in the negative. Are you in Apple for the next 20 years? Do you think the quarter of $1 trillion that they have in cash is going to send Apple somewhere where they're not going to invent the next cool thing? That's the question. So are you in it for a long haul as a growth investment? Are you looking for income from Apple because their dividend's kind of small? What are you trying to accomplish? Are you just in for the equity play for a year? Well, you lost. And those are the types of things that you have to evaluate why you bought something and whether it's accomplishing your needs.
Yeah, I completely agree. I think, taking a look at, what do you have and why you have it. I just want to thank
Seth for agreeing with me. John didn't agree with me. I appreciate him stepping in and just saying, wow, thank you.
Well, here's the thing that I thought. I thought the first thing that anyone should do, and this is not to sound trite, but the first thing you do, I believe, when you see all this stuff going on is, hey, you know what? Take a deep breath, relax, and say, you know what? Hey, perspective is everything. And Ben, I think that's kind of what you were saying.
Are you mad I didn't share my coffee with you? Is that really what this is?
Ben, it does look good and it's half gone. So yeah, but no, I think taking a deep breath and just evaluating and saying, as Ben was talking about, you know what? Hey, if you're looking for income from your investments and you're all in Apple, well, there's probably something to reevaluate there.
Right.
But the fact is, when it comes to these things, there's no reason to necessarily panic. But I just want you guys to understand, and I want our listeners to understand, when the markets are down and your portfolio is down, let me just tell you, we understand. And I often tell clients when they come in the office, listen, my statements come in and I see them before you do. And I understand that this is a tough time. It's a difficult time. And so before you make any quick reactionary type of moves, just take a quick breath. And also another thing that I would say during these times when we see this extreme market volatility is sometimes it makes sense to kind of shut off some of this media that is constantly streaming your way. And it's different now, guys. I'm just going to say, from 25 years ago, we weren't scrolling through our phones. You weren't constantly assaulted with media headlines about what's going on. Do we have big market drops in the past? Absolutely. Think about 1987. Think about 2000 when the internet stopped.
Right.
Stocks
I think it's
dropped.
interesting. How did you get that information, though? You read it in the paper, right?
You did. A day later.
Day later, and
Yeah.
you got your statement, 2 months later, maybe a month
right.
later. I mean,
Yeah.
I think there's so much ability to have high volume reactionary events that compound, the market influences that happen on these. I mean, you read some of these tags that say, cycle of volatility. Now, there's a guy out there trying to save a percentage point or whatever they think they're saving by being passively invested, who gets freaked and says, fine, I'm going to cash. The next day it goes up and they're like, oh, I probably should get back in. And I know there's people listening to this show that they do that. And this is something that you have to curb how you manage it. It can't be an emotional decision.
Yeah, absolutely. And I think too, Seth, that the media, there's no doubt, the news media is motivated by ratings and clicks. And the worse they can make a story sound, I even feel this when I see the news at night. If I'm watching a 6:30 news with ABC or whatever, there's always something like, the first thing is, it's a busy night out there, and boy, the traffic, the weather on the East Coast is, here I'm on the East Coast, there might be a small section of the highway that's having some real problems, but they just make that story sound like this is the most important thing going on in the world right now, is the fact that 95 has some people slipping off the road. They make you sound like, I cannot leave my house. This is a crazy time. I am not, even though there's not a drop of snow out there, but they make it.
Yeah, I know. It happens all
they
the
do
time.
the same exact
Hey, you
thing.
got another nor'easter coming. We're like, we got 3 inches.
Yeah. And but the weather media does the same thing that the financial media does, and the more that they can make you turn on that, click on that, or to stay tuned, the more it happens.
You're right. Sensationalism is a real thing. It's here. It's not going anywhere, and it gets people's attention, and it gets them, worked up. And frankly, we all have these drivers in us, right? There's the emotions, there's the fight or flight response, and one of the things I think that we have the ability and is fantastic, as a part of the human population, just being the human experience of what it is we can take a step back. We can take a look at that and we can say, okay, I'm feeling anxiety here. I'm reading all these articles. So maybe I don't need to go step into the media because I have already done the work ahead of time.
Exactly.
If you have, right? Hopefully, we've mentioned a tactical allocation as a percentage, as a part of your plan, or having a plan and understanding, hey, I'm going to go ahead and be 100% passive. And I'm okay with that because I know that I'm doing these things over here. So get back to that, like that brick and mortar or that blocking and tackling. Put your head down, grind it out, work at your job or whatever that is for the day. Contribute back to your family. You know what I mean? Because you've already gone ahead and you've taken a look at this. It's going to be okay, especially if you have. But on the other side of that as well, and we want to talk a little bit about this, I think, with some of our listeners out there that haven't had a chance or really haven't taken a look at what it is they're doing and why. And we understand that as well.
Well, I think the blocking and tackling is a great sports analogy. But the question is, and we're going to talk a little bit about what to do when the market drops. Right? That's the tagline here. But I think when we talk about blocking and tackling, those are defensive efforts, right, to protect a long-term
Speaking football
outcome.
here.
Right? We're talking football, right?
Yeah, we didn't want to get back to football today after the lousy weekend.
I can block offensively too if we're going to just
So, but that happens on both sides, and people don't realize that you have blocking and tackling when you're on offense or defense. And
unless you're the Patriots.
Yeah.
Sorry.
Sometimes we don't have all of that. Yeah.
This
Thanks, Seth.
This
Thanks.
show's going to take a real quick turn, Seth. So anyways, the piece about this that's interesting is that a lot of people are all offense with no blocking and tackling when they're passively invested. Right. And it doesn't mean that you can't have a portion of your assets that's low fees passively. You say, hey, listen, this is my long-term money. I'm not going to spend this portion of my money till I'm 80 or 90, and that's an extra 30 years away. Okay, but there's a piece of it that you say, I need some blocking and tackling. There's winners and losers in today's market, and there was winners and losers 2 months ago in yesterday's market. The winners and losers, 2 months ago were the passively invested, high-tech allocation people. We talked about, I think in one of the other shows, we talked about the FANG stocks, Facebook, Apple, Amazon, sure. Netflix, Google. They were skyrocketing, doubling in value, in some cases almost tripling. And there's lots of gains in that tech side, and it was causing the S&P to have some kind of unbalanced returns.
But Ben, that's interesting because, when those are going crazy, what is everyone interested in buying? When the markets are going crazy, the prices are going up, everyone's interested in getting into Facebook. Everyone wants to be on Amazon, Netflix. They all want to be there because the prices are going up. So that's one of the things I wanted to discuss today is the fact that when stocks are weird because stocks are really like the only type of thing that you can buy that no one wants to buy them when they're on sale. Right. No one wants to buy. Everyone wants to buy a stock when the price has gone through the roof and they're reading about it in the paper or they see an internet story about Facebook. Everyone wants to buy it then. But they're not interested in buying it when the stock market is on sale. And the stock market is on sale, folks, when you see a 600 or a 700 drop in the markets. That's when things are on sale. But it's very different because...
But people are selling then, not buying.
Exactly.
But logically they know that that's what they should be doing. And this is where tactical investing and technical analysis is so key because it takes that emotional side out of it, John.
Yeah, and that the emotion side is, we all know that the markets are driven by emotion. And one of the things that we look at, and we'll talk more about our past our tactical portfolios, but we try to remove the emotion from things. But just remember, when you've seen the markets drop big time, maybe it's time to double down and to look at maybe putting some more money in when things are getting rough.
Hey, we're going to take a quick break. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. You can also find us at Facebook at /3D Investing. And if you're out there in our podcast world, thanks for listening. Please like, comment, subscribe. All those things are fantastic, and we appreciate you for doing it. Again, you're listening to Money on Tap. We'll be right back.
On this Cliff Notes edition of Money on Tap, Seth, Ben, and John have a discussion about wills and the alarming percentage of boomers who have neglected to have a will in place.
Statistically, 44% of boomers still don't have a will. 44%.
Yeah, it's huge.
Yeah, but 57% people don't think they're going to have any money to pass on. So they're saying, well, why waste the money on a will because I'm going to spend it all anyways.
Well, that's true because then you're right. The 35% plan to spend whatever money they have left on themselves. But, there's always the what if scenario. Like, what if I don't make it to that day where I've just completely cashed out?
We have people, they walk through the door. I sit down with people and they're like, you know what? If I die and there's money there and someone's got to figure it out, well, let it be their problem. I don't want to worry about,
make them work for it.
Yeah, and it's like, well, it could be more efficient and you save a lot of money that you've worked really hard for to pass on to your family or friends or charities or whatever. And they're like, I don't care. I'm not going to care because I'm not going to be here.
Sometimes it's interesting to get all these different perspectives that we get a chance to get a bird's eye view of. And we have different perspectives ourselves. I know that when we're talking about our own families and our own family's plan, John is different from Ben, is different from me in how we're planning what our intentions are. And so all across the board, no judgment, people, just interesting to find out what the numbers are.
I think one thing that's not monetary around doing proper estate planning and doing these documents is preserving the family unit. Because if you leave this thing just...
not buttoned up.
Yeah, not buttoned up. You're going to create a huge amount of strife and stress inside the family unit. Even if you don't have an I love you will, as they call it, to your spouse, it can be frustrating. It's complicated. And if you don't make this thing neat and clean, it's just going to create unnecessary problems inside your family. Who cares how much money they do or don't get? If you don't want them to...
they all hate each other after you're gone.
Yeah, what did you really accomplish? I think that's the non-monetary thing to focus on in this area.
Thanks for joining us for this Cliff Notes edition of Money on Tap. with great tips from the pros in three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. Now here's more Money on Tap with Seth, Ben, and John.
Welcome back. You're listening to Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we're going to do, and that's what we're going to talk about next. Is we're going to talk about what to do in this market, because there's all sorts of things that we could be doing in reaction to our market. But what to do might be really the most appropriate place to try to land and finish things up here at Money on Tap. Again, you can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. Also, podcasters, thanks a lot for liking. Thanks a lot for subscribing. And we look forward to being in touch with you as well.
You know, if you are already retired out there and you are taking distributions on a regular basis, it may be that you don't necessarily you may not be, you don't have to have that income. It may be a good time when the markets are down, maybe to slow down on some of those distributions or maybe even reduce them a little bit. However, if you do have like a guaranteed type of annuity in place where you're getting guaranteed income coming in from that, no need to slow down those returns, slow down that income at all. But if you are in a variable portfolio where your market value is really down quite a bit, maybe if you have the opportunity, maybe you can slow that down a little bit. It's a good thing to review with your financial advisor to see if that's something you should consider. But that could be helpful during a time where the markets are really down. But one of the things that I just really want to emphasize to all of our listeners today is just to remember to keep a long-term perspective when it comes to your money. It's so easy to get reactionary. Don't give up. And wait for that dust to settle and keep discipline with what you're doing. It may even be a good time, as we were talking about before the close of our segment here.
I mean, John, I got to bounce off of that and say, you know what? If you're in turmoil and you're like, I really don't know what I'm doing and I'm losing a bunch of money, and maybe the discipline is not really to keep, it's to call.
Yeah.
Give us a call. Let's talk about it. Let's see if your thought and your discipline is really the right thing. Because honestly, there's a lot of people. We have a lot of people. We have tens of millions of dollars in literally just tactically managed assets.
Sure.
And 3, 4, and 5 weeks, most, if not all, of those tactical managers that we use have gone to cash equivalents or short-term bonds.
Okay, so let's talk about that. Sometimes I hear that word tactical, and I sometimes wonder if people are listening and they're kind of like, well, what does that exactly mean? So there's a couple of different types of strategies that people can employ. And we see many of the people that come into us for the first time, many times when we look at what they have going for themselves, we'll see that they really have a very passive type of strategy in place. That means like, I picked a Fidelity S&P 500 fund, I picked this fund, and there's not necessarily any kind of maneuvering that's happening with that, right? So a passive strategy would mean like, I'm going to buy it.
I'm going to hold it forever.
Yeah, set it, forget it, as Seth will say. But the fact is, there's no kinds of fine-tuning going on with that. Sometimes the clients will think, the investors will think, well, that's their job. They're monitoring that. They're moving that around. Well, that may not be the case.
Well, okay, so there's active and there's tactical. We've talked about this in past shows. Yep. But I mean, active is people are moving to adjust to the market, but they're still in the market.
Yep.
Right? So they might sell this and buy that instead or whatever. But the tactical component that you can throw on top of active, okay, is that sometimes you just get out or you get to a whole different space entirely, that you're not even in the same investment domain. Like you're in a cash money market or you're in a treasuries or a treasury fund or something like that, or
something
you've gone to
convertible,
short-term bonds as an option because you think there might be growth there. That tactical move has occurred in our portfolios pretty heavily, if not almost entirely. And that was 3, 4, and 5 weeks ago with all the different managers we use at our tacticals. We have a whole tactical slew of managers. If you're sitting in and watching this market drop, the best thing for you to do, if you truly believe in what you have, is yes, buy and hold, John. Right? That's why you went in that way. That's what you do. That's the thing. If you're saying to yourself, I don't even know if what I bought was worth holding.
Yeah.
Like I'm not even sure.
Then it's time to call. Yeah,
that's the time to call. And if you're going to make a move, and you say, I want to make a move, or I want to get out of the market. If you're going to get out of the market, when do you get back in? And if you don't have that answer, then you shouldn't have gotten out. Because you can't have this be an emotional decision. Oh, the market's up 3 days, so I'm going to get in. we use this technical data to drive in and outs of the market. Okay. And that's just the story that goes through. There are various versions of moving averages and trigger points and all different types of things that happen. And that's the kind of stuff either you're going to pay for someone to manage it and not worry about these rides, or you're going to buy passively and you're going to endure these rides. And that's the difference.
I have a cousin who is a Navy SEAL, right? He's part of a tactical unit. And so they have available to them a lot of different tools and a lot of different strategies that they can employ when things go in a bad direction. And it may be a knife, it may be a bomb, there's so many different tools that they can use, but they're a tactical unit, and that tactical unit responds when one thing happens, then they go this way. When another thing happens, they go that way. So it's a tactical rolling unit, as opposed to just a unit that just, hey, we'll just kind of roll with whatever. We're going to follow the same strategy. That's the same type of thing that we'll employ with our clients.
And I think what's really nice is some people are like, well, I really believe in the passive efforts, and there's passive investments that have tactical overlays as well, which is kind of interesting. Like you can, like if you say, hey, listen, I really want to own the S&P 500, but I'd really like some stop gaps, put in there that, will really protect me from huge losses, huge drops and stuff like that. There's things you can do. I mean, there's opportunities out there that you can look at and so forth. But a lot of people think that they're either going to hire some really expensive financial planner or they're going to invest passively at some inexpensive.
Very, very, very cheaply, yeah.
Yeah. And the thing is that nothing's free. Okay, like these zero cost funds and all this other stuff. That
sounds good.
It sounds good. It's not really free. I mean, we all get that there's no free buffet around here. So, but you need to know what you're buying, and I think you need to know what you're investing in and whether or not making those moves is relevant. Having
a game plan in place is really important. So we've talked about really today about some things that are very important to do when the market drops. Now let's spend a little bit of time talking just about human nature and about what not to do. Seth, I thought maybe you could kind of highlight that for us.
I'd like to, but I think that there's something that we need to talk about, which is bringing back in a little bit of that 401k conversation, because frankly, the majority of what people have out there right now is warehoused in a 401k. Sure. And I did have an experience here this last week where a client was basically had closing out a 401k and moving some things around. And in the process of doing that, they had lost 11% of what they had in that 401k. Now, most of the people that are in the 401k space really don't know what they have. If you're there and you don't know what you have or why you have it, that kind of comes back to some of what's been said previously. And one of the things we'd love to do sitting down with you is help you understand that and position yourself to a place where you're getting the most out of where you're warehousing or where the gains that you're making, which the contributions that you're making towards your retirement. So the gentleman that I'm thinking of had he thought he had put himself into a place where he didn't have as much exposure to that kind of volatility. Unfortunately, he did. And so doing the research, helping him understand this is what you had and this is why the moves this is why you lost 11% of your portfolio. So that would be an unacceptable risk.
And this is why moving to us makes a lot more sense than it did before for you too.
Yes. Yes. Yeah. So, that's one of the things that you can do is you can, we're here to help. That's one of the biggest reasons we do what we do.
People have no idea the amount of risks they take. They have no idea. And 2008 is starting to become a bad dream. Oh, yeah, that was a long time ago. That's not going to happen anymore. We're 10 years. We're a decade. I mean, all those 10-year, this is the whole thing that's sweeping our industry. All those 10-year averages are going to – 2008 is dropping off. So you don't want to ask for 10-year averages. You want to see 15 and 20. You want to see companies who have weathered that storm and weathered this storm. And you're going to need to start asking for 11-year histories. 11 or 15. Or a lot of these fund companies are starting to come out with that and saying we're providing. Because usually they show 3, 5, 10, and since inception. But people want to see 2008 in everything.
How did they mark?
So now they're talking about adding a 15-year return, which is interesting.
Okay, so what not to do? It is not time to panic. When you see your investments down, this is not the time to say, hey, I'm just going to pull all my money wholesale out of the market. This is one of the most common mistakes that we see people make. They see the market's down, all of a sudden, I want to move to cash. We have gotten those phone calls. We don't get a lot of them because of the strategies we employ. But there are people that say, I am down, I am out, and I want to move. But the thing is this. If you look back at any period of history, pulling money out when the market is down has never been a successful strategy. Think about this. If we take a look at where the market was in 2008, the market at these all-time lows, if you decide at that point, I am out of here, and you pull all that money out, then again, the question comes back, as Ben was talking about earlier, okay, so when do I go back in? And but it's never been a successful strategy to get panicked and to move that money out. It never has been.
Well, some people they've gotten so burned in 2008. They said we're never doing this again.
Yep, CDs,
yep. CDs, fixed cash. That is what it is. We're going to figure out how to live off of that. And some people, they bought in and they watched it go up and they finally said, okay, it's back to where it was before they get in, and now they're in this. People need help, and a lot of people don't want to pay for help. It's kind of like, do you want to wire your own house? Do you want to do your own plumbing? It's not that I can't. I mean, I grew up with an uncle who taught me how to do electrical, but I'm not going to wire my own house because it's not what I do every day. Yep. I want someone who knows exactly what they're doing. I don't want to have to take a chance or worry about it, miss something, whatever. I want somebody who's in it all the time, taking care of me and my family. And that's part of what people think. There's this world out there, and honestly, it's funny because I see Fidelity and I see Vanguard doing it over and over again, saying, you can do this yourself. You can do this yourself. Stick it with us. We'll charge you low fees and we'll give you like a phone call, an 800 number, and they'll chat with you and talk with you. But the advice is set it and forget it. But I don't know that that's the market we're in anymore. And the historical, we've talked about all the historical investing efforts. We've talked about how making money 20, 30, and 40 years in the past is going to change as we move forward with this demographic shift that we've talked in the past episodes. And if you don't know what we're talking about, that's even another reason to say, hey, listen, I need to learn more. But this is not an industry, and it's not something that you want to take all the risk yourself. And thinking you have Fidelity or Vanguard or Charles Schwab or some of these back-end do-it-yourself firms protecting you, that's not the truth. The winners today are the tactical and active managers, the annuities, and the super conservative assets. Right? The winners 2-3 months ago were the passive investors, and it is a back and forth. But the difference is passive investing requires lots of time. And if you're heading into retirement and you need income now, you don't have lots of time. And that's where some of the changes have to occur. I often talk with folks when the markets are down, and it's just a good opportunity to talk with them, to talk about the pain that you may be experiencing. You know what? Whether it be financial pain, I think we've all been down at different times in our life. Ben, you've had some health challenges in the past. I've had some health challenges over these last few years. But I can tell you sometimes when you're down and you're either in that wheelchair or you're in that hospital bed and you've been there for a long time and you've felt down, sometimes it's hard to think, wow, things are ever going to go back to normal again. You think, well, how will I ever be able to run again, to do this again, to do that again? And sometimes when you're down in that valley, you think, wow, I am just everything about the situation that you're in makes you think that it's not possible that you're going to come out of that. But the thing is, for the most part, most of us, when we've gone through hard times, we come back through that. We actually come back through stronger on the other side. It just doesn't feel like while we're down that valley, whether it be with your 401k valley, whether it be with a health valley, maybe it's even a difficult relationship you're in, you just don't think that it's going to come back. But the fact is that you do come back, and the sun does come out again later on. And I just want people out there that see that their dollars are down to realize that, this is a temporary time frame that we're in. Things will come back. They'll come back to normal. Don't go all of a sudden wholesale and say, I'm out of this and I'm done and all that. Remember that there is a future. And I think remember that there are people out there willing to help, and if it's not us, find somebody to get you some real help. Understand I think about all the people from, 2008 past. I remember talking to people about annuities prior to 2008 and how annuities were horrible and expensive and blah, blah, blah. And then after 2008, I really wish I had that annuity. And the people who bought the annuity prior to 2008 loved the annuity because it saved them from that tragedy. We've seen people buy that stuff. Stable income in retirement is a wonderful thing for retirees. It's not for everyone. And you need to know, so annuities have been a great winner through this process. Tactical management's been a great winner. You got to know what your risk tolerance, your time horizon, your investment objectives. You have to bring that all together and find what's good for you, but you need help.
Seth, I thought we would maybe just wrap this show up by just talking about some things that will leave clients better prepared for the next time we have this market drop, because we know this is a conversation we're having right now, but we do know that it could be a week, it could be 10 days, it could be 3 months down the road or a year down the road, where we want people to be better prepared for what's coming next, for that next market drop. So one of the things that you often bring up, Seth, and I think this makes a lot of sense, is spend some time, whether it would be with us or with someone else, talk with your financial advisor and reassess your risk tolerance. Seth, talk about a tool that we have, that Riskalyze tool that we use.
Yeah, well, risk is just an interesting construct, right? What is it? And at what level are we okay? And what areas that we take on risk? People sometimes are just baffled when we talk about probably the highest risk that you're taking right now is either the business that you own or in your employer, in your employment situation, because it is something that is not guaranteed, even though you feel like it is. But when we talk about investments, we need to understand, like, what is the, what's your threshold? Are you okay if you have $1 million today at being at 800,000 in the next 6 months, or is that something that's completely unacceptable? So that's typically kind of that risk assessment that we walk through and understanding what people's portfolios do. And we also use it in another scenario where we really try to understand how to squeeze more out of a portfolio, to get more gains in a scenario where risk might be happening. And that's an important part for us as well. One
of the things that we love doing is we love analyzing. Seth, earlier you talked about how many people have their largest asset in their 401k. What we love to do, and we've done this quite a bit for listeners here over this past year, is helping them assess the risks that they have in their 401k and help them realize, hey, if the market goes down this much, you should expect to see your portfolio go down by this much, or if the market goes up, and vice versa. But I think that program that we use is very, very helpful for people. It helps them better assess the risk in their own portfolio. So some different ways that we can help going forward. Having some good tactical asset management in place makes sense.
Yeah, I mean, the Riskalyze thing, you can go right to our main page at Brayshaw Financial, www.brayshawfinancial.com. Go click on, just scroll down a little bit down the page, you'll see Riskalyze, and you can put in your portfolio, and you can see how your portfolio would rank on risk on that scenario. And you can also put in other holdings that your 401k might offer, and you can see how they might compare and the standard deviation of how those move back and forth, negatives and positives and pros and cons. And you can say, hey, listen, you take this test and it tells you based on that same scaling, how would your risk score be, calculated on that same scaling to apply to that, and find out, it's between 0 and 100. And if you say, hey, I can take a 90 risk and your portfolio comes in at a 70, well, you're all set. But if you say, hey, I can take a 50 risk and your portfolio comes in at a 90, well, you might have some thinking to do about what kind of risk you're taking.
Another piece of that too that's interesting to see develop is how returns are not dictated by the higher level of risk that you take. Let's say you take a 90 risk, it doesn't necessarily equal a better return, and people usually associate that type of a relationship with the risk reward, and that's not necessarily true. A lot of the time, the more we find that we work within different kind of management styles, is that we're able to construct portfolios with less risk, but with a better return as well.
And we do this, folks. This is totally free. We have people access to this. This is a service we pay for from a third party, and we provide it to the entire public free of charge. You're going to have to put in your information because that's part of the demographic thing to do the questions to see what age you are and your name and so forth. And they're going to send you an email to verify it's you and blah, blah, blah. So that's all standard. It's not a marketing ploy or anything like that, but you have to do that. But it's totally free, and no one's going to bother you from our company. Someone will call and say, hey, do you need any help? Do you understand what you're doing? Do you need any help understanding your portfolio? People are going to do that. It's a simple, small phone call. Not interested? No worries. But I would encourage everyone to use that thing because it is a phenomenal tool. And if you are trying to do it yourself, and that's totally okay, use this. This would just be another analysis tool for you.
Another thing just to remind people of, if you have 100% of your money in the market and 100% of your money is sitting in your portfolio and you don't have a cash reserve on hand, well, of course you're going to be panicked. When you see things go down in the markets and you're thinking, well, if I need money to pay for my car payment or some car repairs I have coming out, it's coming out of the market, you know what? Having the proper amount of money in a cash reserve makes a whole lot of sense. Also, you may want to look at this. If you are looking for preserving your principal, or you want some guaranteed future income in the future, maybe an annuity is something to consider for you. If the fact is that your current portfolio is fluctuating up and down and you can't get steady income off of that, maybe it's time to consider some type of an annuity that will give you that kind of income in the future.
And there's people listening to us, and I know, and there's people out there that say passive's the only way, or active's the only way, or tactical's the only way, or annuities are good or bad, and insurance is good. I mean, all those things. I don't believe any of that stuff. I believe that there's appropriate and inappropriate for each and every person. You need to find something that solves for your fears, your risks, and your needs.
Glad you chose to spend some time with us today, listening here at Money on Tap. I hope we were able to give you some good perspective on what you should do or what you shouldn't do when you see the markets dropping. Volatility, it's here. There's no doubt that it's here to stay. So with that in mind, the best thing you can do is try to make sure that you're properly prepared. We'd love to have an opportunity to sit down with you, and we consider that. We really do appreciate those that call in and ask us for help, because that's what we're here to do. We really, truly have a passion to help you and help you through volatility and understand, how you can take this opportunity to improve your situation. Or maybe you're doing the best thing that you possibly can. We're going to tell you that too, but it's really nice to have a professional opinion, and that's what we share with you here at Money on Tap at Brayshaw Financial Group. You know what? It's been a lot of fun. Again, thank you for being here with us at Money on Tap. We look forward to seeing you. You can reach us at 855-226-8551 or info@yourmoneyontap.com.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.